I think there's a possibility, maybe not a probability. I think there's a possibility of a liquidity crisis. I think there's a possibility, given how much volatility we'll face, that there is a black swan out there that causes a liquidity crisis. If it were going to happen, my suspicion, the thing that makes me most nervous about, by definition, you don't see a black swan, right? But the thing that makes me most nervous is junk corporate debt. And the holdings of several $1 trillion in junk corporate debt in ETFs, where the superstructure is very liquid and the underlying assets are illiquid. If you had a circumstance where there was concern among the population credit quality, the junk bonds started to sell off.
In this excerpt, Rick Rule, a seasoned investor, expresses grave concerns about the potential for a liquidity crisis looming over the US economy. He points to the significant exposure to junk corporate debt and the intricate structure of ETFs, where underlying illiquid assets are held within seemingly liquid vehicles. Rule warns of the risk of a domino effect, wherein a sell-off in high-yield bonds could trigger a severe liquidity crunch, exacerbated by difficulties in liquidating ETF holdings. Additionally, Rule highlights broader economic vulnerabilities, including the possibility of an economic slowdown driven by rising interest rates and demographic shifts. He also underscores the looming supply shortages in conventional energy and base metals, which could further strain the economic landscape. For more essential insights and analysis, don't forget to like, share, and subscribe to our channel, and turn on post notifications to stay ahead of the curve with our latest update.
I'm cautious on the demand side for the economy. I need to say, I've predicted 17 of the last 3 recessions. So being a credit guy, I'm always concerned. But I sort of believe that we haven't had a real economic slowdown for a long time. And perhaps as a delayed consequence of an increase in at least nominal interest rates, it wouldn't surprise me to see an economic slowdown. An economic slowdown, we're going to have a very strong market for commodities simply because of global population growth, an increase in living standards among the poorest third of humanity, and the fact that society has underinvested in extractive industries for 30 years. Meaning, I think that commodity supplies are going to be tight 5 to 7 years out, irrespective of whether we have a recession. If we do have a recession, the impact of that will be muted because you can have declining supplies if you have declining demand and prices don't move. I realize that's a convoluted answer, but it's the best answer that I can give. I have zero doubt that we're going to have supply shortages in conventional energy, in oil and gas, not because of demographics, but rather because of an underinvestment in sustaining capital by the industry, including state-owned industries, of $1 billion a day. I think that we're going to have supply shortages in base metals simply, again, because we haven't been investing in productive capacity, and the permitting timelines are extraordinary. Whether or not prices go higher or lower and share prices respond well really depends on the strength of the general economy. What concerns me more, perhaps because I'm 70, is the off-balance sheet liabilities. If you add back the net present value of promises society has made to each other, Medicare, Medicaid, military pensions, Social Security, according to the congressional budget, not some cranky, fat old libertarian, the net present value, not nominal value, but net present value of those obligations is $120 trillion. And you try and service that debt with a demographic that gets older every year and a budget that's $2 trillion in deficit. Sometimes I'm happy that I'm not an economist. As a credit guy, what I would say to a borrower that was $140 trillion in debt and was enjoying negative free cash flow of $2 trillion a year is start saving. And it's very difficult for me. I mean, I understand how you dig your way out of this. People your age say to people my age, you guys voted yourself all this cool stuff and you forgot to pay for it. So you pay for it because we're not gonna.
Okay.
Politically, it's probably not palatable to end Social Security, Medicaid, Medicare, military pensions, and the Environmental Trust Fund. But that, it's very difficult for me to understand how we dig our way out of this. I'm concerned that my countrymen aren't good enough at arithmetic or whatever their shortcoming is, that they don't understand the drag of the net present value of entitlements on the economy that my generation leaves to your generation. And it ain't pretty. People talk about the wealth effect, how the baby boomers are allegedly going to leave $120 trillion or $140 trillion, pardon me, in inherited wealth to the next generation. They're also leaving them $146 trillion in debt, meaning that the net transfer of wealth is negative. Now, it goes to different people. You know, there's a whole bunch of rich old guys like me that are going to leave lots. And then there's everybody else who are going to get left a donut. And those who get the donut are not going to be happy. I buy gold not because I hope it's going to go up, but rather because I'm afraid it's going to go up a lot. And that whole, I'm a very happy 70-year-old fat rich guy. I don't want my standard of living to change. I don't want the gold price to go to $8,000. I don't want the whole set of circumstances that would cause that to occur.
Right.
I'm afraid it's going to, as opposed to when I talk to people here on the floor and they say they can't wait for $5,000 gold.
Yeah.
The idea that the bond market didn't get waxed worse with a doubling of nominal rates astonishes me. I'm delighted to be astonished, believe me. I'm really happy to be astonished. Would I buy a U.S. 10-year treasury? No way. I'm a credit guy. They're paying me 4% in a currency where the notional CPI rate is 2.8, where I think the real deterioration of the purchasing power of my US dollars is more like 7% compounded. The idea that I would take a negative 3% yield in favor of a creditor that has $146 trillion of liabilities.
Wow.
I mean, come on. I think there's a possibility, maybe not a probability. I think there's a possibility of a liquidity crisis. I think there's a possibility, given how much volatility we'll face, that there is a black swan out there that causes a liquidity crisis. If it were going to happen, my suspicion, the thing that makes me most nervous about, by definition, you don't see a black swan, right? But the thing that makes me most nervous is junk corporate debt. And the holdings of several $1 trillion in junk corporate debt in ETFs, where the superstructure is very liquid and the underlying assets are illiquid. If you had a circumstance where there was concern among the population in credit quality, the junk bonds started to sell off. People started redeeming ETFs. The manager won't be able to sell the underlying security. And that would be truly, truly, truly ugly. And I'm not sure I think that that's a probability, but it's a strong enough possibility that I'm chased all the way out of the high yield market, even for credits that I know and like.
Wow.
The most important takeaway, however, for your listeners is that they don't have to be as stupid as their neighbors.
Right.
You have to have liquidity on your own balance sheet. You can't play the same complacent game that you played for the last 40 years. I'm not trying to say that you should lie in fetal position in the corner and admit defeat. But you have to understand that the arithmetic surrounding you has been less benign than it's been for the last 40 years. And irrespective of what the big thinkers do, which is almost invariably going to be stupid, you don't have to be stupid. You have to organize your life in a way that makes some arithmetic sense. Yeah. I think the quote was, you don't need to lose your head when everybody about you is losing theirs. For me, if I looked at the juxtaposition of risk to reward between the space that I used to inhabit, which is the juniors, and the more senior companies exhibited much, much, much better ratios of risk to reward. And we were in such a speculative environment, such a narrative-driven environment, that dumb money chased out smart money. The dumb money has gone to money heaven, which is where it rightfully belongs. And so now there's room in the space for some smart money to come back. I think that's useful. I would argue that the extractive industry has been over rather than underfunded for most of my career. I would argue that the bane of the gold industry has been that its cost of capital, its real cost of capital, has been sub-zero. If you define the cost of capital as being relevant to the premium to net asset value that equity capital has been raised at. Traditionally, the gold mining sector has been priced at about twice NAV, which means that anybody who is able to raise any money at 2 times what their company is worth has a negative cost of capital. So I would suggest that the bane that the industry faces is not the presence of high cost of capital, but rather a history of low cost of capital. And I think that has incented truly insanely stupid.
In today's insightful discussion, Rick Rule sheds light on the looming possibility of a liquidity crisis in the US economy, stemming from concerns over junk corporate debt and illiquid assets in ETFs. Rule's cautionary words emphasize the importance of individual preparedness and prudent financial management amidst economic uncertainties. As we conclude, we urge you to reflect on Rule's valuable insights and take proactive steps to safeguard your financial well-being. Remember to subscribe to our channel for more essential updates, like this video if you found it informative, and share your thoughts in the comments below. Your engagement helps us create more content tailored to your interests. Thank you for watching, and we'll see you in the next video.